and welcome back to A Brief Account and the first of our sessions for 2025. My name is Andrea Sanford and I'm joined today by my colleague Ian from our National Accountants Liability team.
Good morning, everyone.
So today we're focusing on claims against auditors. Now, as a team, we're seeing more and more audit claims and they're often high value, complex and expensive to defend. Today, we'll take a broad look at the role of an auditor, what can and does go wrong, and the legal issues that we frequently see arising. We'll then provide some practical tips for how to defend audit claims. Of course, we won't have time today to cover all of the issues in this broad and complex area, but we will offer an overview of common themes based on our own experience and that of our National Accountants Liability team. If you do have any questions along the way, please pop them in the Q&A box or feel free to contact either me or Ian directly after the session, and we'd be happy to discuss these further with you. So let's look at the role of an auditor and how claims arise. The responsibility of managing the business and preparing financial statements of a company belongs to the directors. Auditors play an important role in holding the directors to account by independently reviewing and reporting to shareholders on the truth and fairness of the financial statements of a company, that they're prepared in accordance with accounting principles and legal requirements and do not contain material misstatements. More on this later, but this is absolutely crucial for maintaining confidence in the financial reporting of companies. So looking at the audit itself, this involves three main elements. First is a substantial risk assessment, so building up a detailed understanding of the business to be able to assess the key risk areas. Next is evidence gathering, focusing on the higher risk areas. And finally, reporting the opinion to the shareholders. Now, this opinion may be qualified by the auditor in the absence of persuasive audit evidence. It's important to remember that the requirement for the auditor is to provide reasonable assurance to support their audit opinion. That's not absolute, and some imprecision is inevitable. So let's look at how claims often arise. The interplay between the roles and responsibilities of directors and those of auditors, coupled with tough economical times leading to more company insolvencies, as well as the practical limitations for auditors in their evidence gathering and review, provides a melting pot of opportunities for claims to arise. High profile, often high value claims, often against the Big Four, hit the headlines, and some familiar ones are shown on the slides. Not all claims are against the Big Four, however, and we as a team are dealing with several audit claims at the moment, involving other regional and national firms. Claims are often brought by companies against directors and the auditors, or the auditors might find themselves being joined as a party and/or facing a claim by the directors. It's important to distinguish between the different roles when dealing with such claims. So we see a wide variety of allegations in claims against auditors, but there are some common themes. Failure to detect material misstatements and/or fraud is one of them. We've already touched on this, but it's important to remember an audit is not a guarantee as to the accuracy of financial statements, which are prepared by the directors. We're currently dealing with a number of claims where the central allegation against the auditors is that they failed to detect material misstatements or even fraud in the financial statements. Central to defending such claims is the scope of an auditor's duty. The International Standards on Auditing, ISAs, which you're no doubt all familiar with, very clearly set out that an audit is not a warranty. Its purpose is to enhance the degree of confidence of intended users in the financial statements. The auditor's duty is to ensure that the shareholders receive an independent view of the financial position of the company, which allows the shareholders to exercise their own judgment. This is achieved by expressing their opinion on whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. It's important to be able to demonstrate from the auditor's file and with expert evidence compliance with the audit process in which the required level of reasonable, not absolute assurance has been obtained, applying professional skepticism throughout in order to defend such claims. So looking at the audit opinion itself, another hotspot for claims to arise is the audit opinion. Auditors are required to give either an unmodified opinion, where they consider the financial statements give a true and fair view of the company affairs at the balance sheet date and of its profit or loss for the accounting period, or a modified opinion. A modified opinion can arise where there's an error, disagreement, or a lack of sufficient audit evidence in a particular area of the financial statements. There are different types of modified opinions, which we won't delve into today, but safe to say there's inevitably a subjective element to the audit opinion. Claims can arise challenging the audit opinion and its effect. For example, that qualified audit opinions should have been given in years where unqualified audit opinions were. We've seen claims where it's alleged that a subsequent insolvency event could have been preempted sooner and/or avoided altogether if the true financial position was known sooner. Such cases can involve significant sums as well as complex issues around breach of duty, causation, and quantum, and expert input is paramount in dealing with such claims. Claims can also arise from third parties who've relied upon the audit, and issues around scope of duty and the retainer become important here. I'm going to hand over now to Ian for a bit more on this.
Morning, everyone. I'm going to touch briefly on a couple of issues that can come up in auditor claims. The first one, which was considered in the Amethyst Drinks case, and you can see that mentioned on the right-hand side, was around who the auditor owes a duty of care to. Now, obviously, there's going to be a duty of care in contract and talk to the client, in effect the audited company. But what about third parties? Normally, it's going to be difficult for a third party to establish a duty of care. If they're going to do it, typically it's a case of showing there was an assumption of responsibility to give rise to a duty of care in tort. Assumption of responsibility is something we could easily spend a session on by itself, but some of the things a court might look at in the context of an auditor are, what was the purpose of the audit? Was it just a statutory audit, or were there other reasons for it? What was the relationship between the auditor and the third party? For example, does the auditor provide other services that involve the third party? Did the third party rely on the auditor, and was it reasonable to do so? Did the auditor know, or should they have reasonably known, the third party was placing reliance on them for a specific purpose? Now, one of the things that most auditors will include in their report, and you can see it quoted on the right-hand side, is a disclaimer. It's commonly known as the Bannerman disclaimer, and it's intended to mitigate against the risk of a duty to a third party. And the Institute of Chartered Accountants in England and Wales recommends its use to its members. The effect of this disclaimer was one of the things considered in the Amethyst Drinks case. So what was that case about? Well, it was a claim against an auditor, in this case EAGK, by a shareholder in the audited company, Amethyst. In short, Amethyst's position was that EAGK had been negligent in its audits, which led to the financial position of the audited company being overstated, and Amethyst paying too much for its shares in the audited company when it purchased them. So this wasn't a trial, instead it was a hearing of EAGK's application for summary judgment, and the main ground of that was that no duty of care was owed, and the court had to consider whether Amethyst had a realistic prospect of succeeding at trial. There were some pretty unusual circumstances, and we don't have time to run through all of these this morning, but some of the important points were that EAGK had a pre-existing relationship with Amethyst. The audit had formed the basis for preparation of completion accounts by EAGK, which had determined the price payable by Amethyst for its shares, and Amethyst and EAGK had been in direct communication throughout. EAGK did accept that this may give rise to a triable question of whether a tortious duty was owed. However, it argued the disclaimer, which was present in the audit report, precluded this. So what was the outcome? Well, EAGK was unsuccessful. The court's view was that this disclaimer is not a silver bullet to defeat third-party claims, but instead simply a relevant factor to whether a tortious duty was owed. So the other issue I'm going to mention is scope of duty in the MBS case. Now, it's obviously not a new authority. It's coming up to 4 years now, but we can't have a talk about audit claims without mentioning this. Could easily spend a session on it alone, but I'm just going to provide a brief overview in a couple of minutes. If you'd like to know more about the case, as a shameless plug, I've got a QR code, which you can see on the top right-hand corner of your screen, and that's going to link to an article that Liam Burnett, David Goodin, and I wrote a couple of years ago. So I've split this slide into two parts: the approach to scope of duty before the case and after it, in other words, the old and the new. I'm not going to spend too long on the old approach, mainly because it's no longer relevant, But the key point was the distinction between information cases, where the professional is only liable for certain losses caused, and advice cases where the professional is liable for all losses caused. Before moving on to look at the new approach, I'm just going to run through why this was relevant to MBS and GT. There are two parts to this background. In 2006, before the financial crisis, the auditor GT had advised MBS it could apply hedge accounting rules in its accounts. And based on that, MBS had bought interest rate swaps. If we move forward to 2013, GT recognises that its advice was wrong, and as a result of this, MBS has to sell off those interest rate swaps. By this time, we're now after the financial crisis, and so these swaps are a massive liability, and MBS incurs losses of £32 million on termination, and that's what it sought to recover from Grant Thornton. So at the Court of Appeal stage, in line with the old approach, GT was able to successfully argue this was an information case, and as a result, it wasn't liable for these losses. The key point in that analysis was that even had GT's advice been correct that hedge accounting rules could be used, these losses would have still occurred. This was because they were due to external market forces and movement in the interest rates. So did the Supreme Court agree? No, and we now have a new approach to scope of duty. The distinction between information and advice cases is gone. So what are we looking at instead now? Well, a court's going to have to determine the risk the professional's duty was supposed to guard against, and then once it's done that, ask itself whether the loss claimed represents fruition of that risk. Applying that here, as GT was aware that the purpose of its advice was to assist MBS in deciding how to proceed with interest rate swaps, the Supreme Court considered MBS's losses arising from those swaps fell within GT's scope of duty. So I'm just going to cover a current trend we're seeing at the moment. As you'll see from the chart on the right-hand side, there's been a real uptick in company insolvencies in the last 3 years, and there are consequences in terms of claims against auditors. If a liquidator or administrator is appointed, they have duties around realising the assets of the company. Why is that relevant to auditors? Well, something they're going to be looking at, particularly if the insolvency came as a surprise, is the auditor's conduct and whether there may be a claim there. In the past, the difficulty faced by a liquidator or administrator has been that whilst there may be a claim, it's going to typically be very costly to pursue, and unless there is a firm of solicitors prepared to act under a CFA, the liquidator or administrator won't have the funds to pursue litigation. But something we are seeing an increase in at the moment is litigation funders who are prepared to take a punt on the claim and buy an assignment from the liquidator or administrator. Common structure is a small upfront payment by the funder and then a waterfall agreement for any claimed proceeds. And this is a current ongoing driver for claims. So what may the future hold? Well, we can't talk about the future without mentioning AI, and you'll see it actually appears twice on this slide. On this subject of AI, I should briefly mention our Future Proof series, in which our firm specifically looks at its impact on professional indemnity insurance. If you'd like to know more about that, you can use the QR code in the bottom right-hand corner to access it. And there's an interesting recent article from David Gooding and Shay Williams, which specifically looks at what AI may mean for claims against accountants. So looking at the future, the first point I'm going to touch on is distribution of audit work and why we think there could be changes in the future. I've mentioned the Audit and Corporate Governance report, which has been in the offing for a number of years now. We were expecting a draft bill later this year, but there's been some recent speculation this bill may be watered down or even scrapped. If it does go ahead, one of the things it is seeking to address is the imbalance in audit appointments for FTSE 350 companies between the largest 4 accountancy firms, the Big Four, and everyone else, the challenger firms. You'll see from the chart on your screen that there's been a slight reduction in this imbalance over the last 5 years. So how are they going to address this? Well, the original proposal was that FTSE 350 companies would need to be subject to a joint audit, which would have seen 2 auditors appointed, with at least one of them being a challenger firm. However, concern with that proposal was that both auditors would be jointly and severally liable if there was an issue with the audit. The latest proposal is a shared audit of the FTSE 350 companies, where a challenger firm simply undertakes an audit of a meaningful part of the overall group. On that basis, the challenger firm is only taking on risk for the subsidiaries that it audits. We'll have to see if this comes to pass later this year. The other thing I've mentioned on the first point is AI. We're expecting AI to impact on the work typically undertaken by mid-sized accountancy firms such as payroll services. It could mean those firms start to look at new work streams, which may include the audit work they've previously stayed clear of. So if I consult my crystal ball, what do the possible changes in the distribution of audit work mean in terms of risk for insurers? In the longer term, the diversification of work probably will raise standards and reduce claims. However, in the short term, it could have the opposite effect. We've got accountancy firms expanding into the audit space. Who is going to handle that work? We know there's already a shortage of experienced senior auditors, and the firms are likely going to be making lateral hires at the more junior end who have experience of the day-to-day aspects of audit work, but not necessarily overseeing it. So this could potentially mean they're learning on the job, and we can see why this lack of experience could increase claims. The other point I've mentioned is the standard of a reasonably competent auditor and the potential impact of AI on this. A current approach of an audit is to determine a pool of transactions that need to be tested and for that pool to be manually reviewed. However, we know AI can analyse transactions much more efficiently. A couple of questions for you. Does that mean we will reach the stage where an auditor who has AI available to them should be using it to test all transactions? Additionally, if the use of AI becomes so advantageous, will we reach the stage where it is negligent for an auditor not to use it? Just some issues to think about. I'm now going to hand back to Andrea to finish with some practical tips.
Thanks, Ian. So let's look at some practical tips for preventing and dealing with audit claims, starting with our top tips for auditors. From a practical point of view, there's a number of ways in which audit firms, big or small, can manage their exposure to potential claims, or from a risk management point of view. Firstly, and really importantly, you must ensure compliance with and regular training and refresher training on current audit standards, rigorously applying the ISAs and ensuring best practice internally in terms of record keeping. You should ensure a culture of quality firm-wide from management level downwards. Everybody's accountable and administrative hygiene and file management are key, as is the supervision and training of juniors. From the outset, it's important to be clear in the remit of the retainer and manage expectations for clients as to the role and remit of the audit. Make sure your client knows what to expect from you and also what you aren't going to do. The retainer letter can be key here. It sounds simple, but it's often overlooked. It's really important to regularly review the terms of your retainers and amend them where necessary. Limitation of liability clauses can apply in audit claims and can be very beneficial in limiting the potential liability. We see this issue arise often and have helped several clients recently with revisiting or drafting these clauses into their engagement letters, often after a claim has arisen. However, it's important to remember there are criteria for any such caps to bite. They must be approved by shareholders annually and upheld by judges as fair and reasonable when cases do arise. This usually means they can be quite high in practice, but if you can mitigate a potential £400 million claim to £5 million, for example, it's definitely worth looking into. For claims handlers, or generally when claims arise, my top takeaways from this session when an audit claim crosses your desk are: consider the scope of duty carefully, look really carefully at the retainer letter. Where third parties are involved, look out for disclaimers of liability to third parties in the wording of the audit report, which may eliminate or reduce the scope of any potential liability. Similarly, look out for limitation of liability clauses that may bite, but remember the criteria that we spoke about, in particular shareholder approval. Remember, audit claims are likely to be high value and complex, so consider instructing solicitors at an early stage. We're here to help. Finally, expert input is key. Choosing the right expert for the claim is paramount. The upshot of this means that defence costs can be high, but given the technical requirements, it's important that specialised input is obtained from an early stage. So overall, and in conclusion, whilst audit claims may not be as common as some other types of claim, they are often high value, complex and costly to defend. We're seeing more and more audit claims, and this is a trend that will no doubt continue with the government plans for audit reform outlined in significant recent reviews of the area, which Ian has already discussed. With stronger powers, the FRC are issuing heavier fines and challenging poor quality audits more than ever. And with the eventual establishment of a strong regulatory body, the Audit Reporting and Governance Authority, there's even more scope for challenge in the future. As always, prevention is best, so ensuring good practice and compliance with ISAs is paramount for firms. Audit's a technical area which requires specialist people who know and understand the processes and can properly apply the correct audit standards. So regular training, along with a firm-wide culture of quality and best practice, will help reduce potential exposure to litigation. So thank you for joining us today, and we hope you enjoyed the session. Please do complete the feedback form, which will be on your screens when we sign off, and feel free to include any topics you'd like us to consider speaking about in our next brief account. Also, remember, if you'd like us to provide you with any further details or if you have any questions at all, we'd be more than happy to assist. So please do get in touch with us via LinkedIn or by email, or just give one of us a call. We'll be back very soon with another brief account.
Thank you.